Good morning. Hello on this fine first day of July. My name is Scott Irwin, and I'm here with my partner Darrel Good, and we're going to be presenting a webinar this morning entitled Updated Supply Demand Price Prospects for Corn and Soybeans. A little bit of administrative items. You can get the slides at the link on the right of your screen today. You can also visit the downloads page at FarmDoc, and our webinar page is also a link to get the PDF of our slides. And there'll be a complete video of our presentation and the Q&A that follows today that will be available tomorrow. Also, please remember to submit your questions during the presentation, and we will try to get to as many of those as we can. Our presentation will be for about the next 30 minutes, and then we'll just have it opened up for Q&A. So please be thinking of your questions and submitting those, and we'll go ahead and get started. Lots of big news in the markets yesterday with the release of USDA reports on grain stocks and acreage, and the implications of those new numbers is what we'll be focusing on today. We're going to start with the June 1st corn stocks estimate that was released by the USDA yesterday. That number came in at 4.722 billion bushels. And that was roughly 200 million bushels higher than the market expected. We can see that the average trade guess going into the report was 4.528 billion bushels. We can compare the size of that market surprise for about the last 10 years on June 1, and we can see that it was a pretty big surprise. Specifically, 194 million bushels larger stocks, which means that you could say there was 194 million bushels less use in the third quarter than was expected. We can see that is the largest surprise on June 1st in the last decade, other than the two huge ones that we had in 2010 and 2011. So definitely a bearish surprise to the market. And the main implication that surprise has is for the level of feed and residual use for corn. We have pretty good measurement of use in the other categories, so we can use these stock levels to imply what's going on with feed and residual use. And that's where things kind of get more interesting. That data for the grain stocks report indicates that third quarter feed and residual use of corn fell under 1 billion bushels. Our estimate, 962 million bushels to be precise. And most analysts, including ourselves, we had expected that to be somewhere north of 1 billion to 1.1. So the number is really pretty surprising, Darrel, in light of the record livestock numbers and fairly robust environment for the livestock industry. Just speaks to the uncertainties that we deal with year in and year out from those stocks estimates. But we take them as they're given by the USDA, and it certainly indicates that feed and residual use has been softer than was expected here in the third quarter. And we can put that on slightly different terms when we now accumulate the feed and residual use for corn for the first 3 quarters of the year. So we now have a pretty good reading on that. That's coming in at 4.585 billion bushels. And again, that appears to be substantially less than what we thought it was a few days ago. Another way to put this into perspective is given the implied usage feed and residual through the first 3 quarters, what does fourth quarter feed and residual use of corn need to be now for us to make the USDA's WASDE current projection of 5,250 for feed and residual use? We would need the fourth quarter use now to be 665 million bushels, which, as you can see, would be much higher than we've had in recent years. And that looks particularly daunting, Darrel, given the very large winter wheat crop that's being harvested in the U.S. right now. So there's going to be quite large supplies of feed wheat as an alternative out there. So that seems like an unlikely outcome as we move forward. So just how much of a cut should we expect in the USDA's feed and residual use as we go forward? This chart is something that Darrel and I produced out of a Farm Doc Daily article a couple of weeks ago when we were looking at, okay, given the information in our stocks reports, how much does the USDA subsequently adjust the feed and residual use? So this chart on the horizontal axis shows the June 1st stocks surprise. And so this year's would be out there close to 200 million bushels. So you can see that it was a big one. And then you might think that the USDA would then adjust the feed and residual estimate in the upcoming WASDE. In this case, that would be the July WASDE that will be coming out in about 10 days by the full amount of that stock surprise. So in other words, a 200 million bushel surprise in stocks, you would drop feed and residual use by 200 million bushels. But in fact, we can see that the USDA in their WASDE does not exactly do that. They tend to fade the surprise somewhat. If we look at the slope of this line, it's negative 0.6213, meaning basically that the USDA drops the feed and residual use by about 60% of the surprise, not 100%. And so if we used this line to predict how much the USDA is going to now change their feed and residual use in the next July WASDE, we would say about 120 million bushels would be the prediction from this relationship. We'll have to see. We can see that the fit is really pretty decent, so I think that it'll be someplace in that range. One final point on the stocks is that basically the story isn't over completely yet. This chart takes the June through July change in feed and residual use in WASDE going back to 1990-91 and says, how well does that predict the total change from June to the final WASDE estimate of feed and residual use for each marketing year? And it makes sense that that line is upward sloping because one of the main big pieces of information that affect the change in feed and residual use is obviously that June 1 stocks number. And so we see a upward sloping line with a slope close to 1. But the real message in this is how much uncertainty still remains, Darrel, in getting to our final feed and residual number. Notice that the R squared on this regression relationship is 0.34. So knowing the change from June to July, you still have most of the uncertainty remaining. And it's just a little bit of a fancy way of saying that the SEP1 stocks number still can give us some major surprises that affect the final feed and residual number for any given marketing year. From here, once we know the July change in WASDE, it can easily be still plus or minus 100 million bushels from there. So we can't predict which direction that's going to be ahead of time, but there's still quite a bit of uncertainty, positive or negative, for feed and residual use this year. So with that, I'm going to hand it off to Darrel.
Okay, thank you very much, Scott. I appreciate that summary. What I'd like to do now is just jump to the supply-demand balance sheet for old crop corn and factor in the new information that we got from the June 1 stocks report, as well as information on other categories of consumption, trying to anticipate how the USDA's balance sheet may change in the upcoming WASDE report. So what we show here in the left-hand column is the June WASDE estimates for consumption, carryover stocks, and price. And in the right-hand column would be our current balance sheet based on more recent information on consumption. The biggest change compared to the USDA's June forecast would be in the feed and residual category. And as Scott indicated, history would suggest that USDA will lower their projection in the upcoming report. Here we've dropped it 100 million bushels, reflecting that relationship that Scott suggested earlier. We might be 25 million bushels either direction from that, I would guess, in the June-July WASDE. The other two changes we've made here are in the ethanol and export categories. In the case of ethanol use of corn, we've lowered that projection by 25 million bushels based on performance to date. I would mention that later this morning we will get the USDA's report of corn crushed for ethanol during the month of May. So we'll still have the fourth quarter numbers yet to go, but we've brought that down based on performance to date, reflecting the fact that we've used quite a bit more sorghum for ethanol production this year than we did last year. And if that continues to be the case, then we would expect to fall short of the 5250 that the USDA has projected last month. Part of that projection is also based on the assumed rate of ethanol production during the summer months. We're anticipating a continuation of about a 1% year-over-year increase in ethanol production. In the case of exports, we have raised that forecast a bit. We're into the final 2 months of the marketing year for exports. We certainly have enough sales on the books to exceed the USDA's projection of 1825. The question is, at what pace will that corn go out the door over the next 7 or 8 weeks? That pace of shipments has been pretty robust in recent weeks, and if that continues, we would expect that exports will be slightly higher. We've raised those 25 million bushels. The net result is that our ending stocks numbers go up about 100 million bushels, gives us a slightly larger stocks-to-use ratio. But again, with so much of the marketing year already completed, these changes are not expected to change the average price for the marketing year. and on the surface suggests that corn prices, old crop corn prices, will continue to track near current levels for the remainder of the marketing year, subject to any shocks from upcoming weather. If we're assuming that we don't have unusually dry or hot weather during July, then we're going to see old crop corn prices continue to maintain current levels. Switching to the new crop on the acreage report that Scott mentioned that came out yesterday, I just start with an overall summary here on principal crop acres for 2016, now estimated at 323.4 million acres. That's slightly higher than last year, and most of that is in the prevent plant. Comes from the fact that prevent plant is considerably less than last year. Interestingly, something we had speculated about for the last several weeks is how this total acres of principal crops would compare to the March estimate, which, as the footnote shows, was only at 317.3 million acres. And we speculated at the time that that seemed unusually low, that it appeared to leave some acreage unaccounted for. And in fact, we did find that in the June report. And interestingly, that increase is spread across a number of crops. The biggest single increase is for harvested acreage of hay, but we also saw increases in soybeans, wheat, cotton, and corn. So 348 million acres total of planted crops, CRP, and prevent plant. That would put us in the ballpark of about where we were last year. So I think that may have been a bit of a surprise to the market, but something that we had thought probably would happen. In the case of corn, planted acres estimated at 94.1 million acres. That's about 500,000 acres larger than the March forecast, but it's also larger than the average trade guess, which came in at just under 93 million acres. So that 1.25 million acre provided quite a surprise to the corn market yesterday. Harvested acres forecast at 86.55 million acres for the 2016 crop. Just a quick look at soy or corn acres by state and how that compares to last year. We see that most states, in fact, did increase corn acreage, all the blue states. A few here in the Midwest, Illinois, Ohio, unchanged from last year. So the increase pretty broad-based across the area, big increases in the western Corn Belt and the Plain states. We do recognize that the June acreage number is an estimate, and the final number will deviate from the June forecast. This is a history of that deviation, and as you can see here, there has been a fairly strong history over the last 20 years of the final estimate of planted acres to come short of the June intentions. The problem with anticipating that is we really will not get much new information on acreage until October when the FSA starts accumulating their certified acreage number. So while we might anticipate that actual acreage will be a bit smaller than the June estimate, it probably will not provide any information to the market for several more months. Then in terms of forecasting the size of the crop, we go from planted acres to harvested acres. Again, we show a history of that difference with the majority of the difference being harvested acres for sorghum or for silage. And then in the last column, we show the current USDA estimate for this year, about 7.6 million acres difference. That's kind of a middle-of-the-road number, seems to make sense at this point. The real question going forward, of course, is what's our average yield going to be for the 2016 crop? We show a trend yield linear trend over the last 50 plus years. That trend for this year would be 167.5 bushels per acre. The USDA is at 168. So the question is, will we deviate from trend this year, and by how much? The critical part of the growing season is just upon us right now. At this juncture in our balance sheet for 2016-17, we are using the trend yield estimate of 167.5. Again, we have been on record as saying that we thought there was an elevated risk this year of yields falling below trend. And in our previous webinar in March, we used 4 to 5 bushels as a likely shortfall based on the El Nino phenomenon and history pointing to elevated risk of a warmer, drier summer than normal. That has been in many folks' forecast until just recently. Now the recent and upcoming rainfall and some forecasts of less of a pressure from high temperatures perhaps in July perhaps has reduced that risk of a shortfall from trend. So that's what we're using at this point. What that would give us for a crop size would be 14.5 billion bushels, obviously slightly larger than the USDA's forecast last month because of the acreage difference. On the consumption side, we did lower the USDA's projection of feed use by 100 million bushels, thinking that the decline this year would be reflected into next year as well. And we use the USDA projections for ethanol exports and other processing uses, getting us total consumption slightly under 14.1 billion, ending stocks of just under 2.3, and we're using an average marketing year price projection of $3.75. Now, the question is, how do you get to that $3.75? And we can really get bogged down in the detail. Time is getting away from us here pretty quick. But basically what we've done, this chart we've presented in a Farm Doc Daily article a couple of times recently. What we show here on the horizontal axis is ending stocks to use ratio for the marketing year, and on the vertical axis is a marketing year average price. The lower line there is fit based on the period 1990 through 2005 marketing years, and then we have moved that relationship upwards to reflect prices in recent years under 4 different scenarios we think have been mapped out by recent price relationships, recently reflecting the weak demand scenario. And so the question is whether the weak demand scenario should be altered going forward. What we've done here is use that relationship for both the weak and the moderate demand scenario, and then taken an average of those two prices to get at 375. We think we've come off the weakest of the demand because of shortfalls in production in South America that has turned export demand to the U.S., but we have not fully come out of the demand problems that emanate from poor economic performance around the world, slow economic growth. So we're kind of in between here, thinking weak to moderate demand would give us an average price of $3.75. The market, I think, is currently just under that, projecting probably $3.60 or so would be reflected by current futures prices. And we think that there may be some opportunities for modest price recovery as we go through July. Certainly at this juncture would not expect prices to get back to the most recent highs that pushed December futures up towards $4.50. Any kind of weather hiccups in July, I would think, could give us a 30 to 40 cent price bump in corn But at this juncture, that would be my upside expectation on new crop corn prices. So with that, I would turn it back to Scott, and we can run through soybeans, hopefully a little quicker.
A lot to get through today. Okay, quickly back to stocks report June 1 for soybeans. We can see that that number came in at 870 million bushels for soybeans. The average trade guess was 829, so that was another significant bearish surprise on the soybean side. We can see that usually the surprises in terms of magnitude are much smaller than what we see in corn, given the numbers in the soybean balance sheet. And that was actually the largest in absolute value and the largest bearish June 1 stock surprise on soybeans for the last decade. But it didn't appear to have much of an impact on the soybean market, Darrel. And so I'll turn it back to you to tell us why not.
Well, I think what we see on soybean stocks on a quarterly basis is what I would consider a lot of noise in those estimates, so that quarterly disappearance in the seed, feed, and residual category tends to bounce around a lot, and we don't feel like we get really final or useful information until we see the September 1 stock. So while this was a bigger inventory than expected, the market tend to discount it, I think, saying let's wait and see what the September inventory says. But in terms of the impact on the balance sheet, we would really see none coming from the stocks report. But as indicated here, we are seeing both crush and exports probably progressing a little more rapidly than forecast by USDA last month, particularly on the export side. I've bumped that number 15 million bushels, recognizing that it could be substantially more than that based on the sales that we have on the books right now. We have about 250 million bushels of unsold or unshipped export sales. And how fast will we actually ship those over the next 8 or 9 weeks will affect that number quite a bit. But I think directionally, exports will be higher, ending stocks slightly smaller. But again, not likely to affect the marketing year average price. We have average prices through May. Assuming that current prices hold through the summer, we would average right around that $9 mark for the marketing year. I think this does suggest that soybean prices will remain firm for the time being, particularly in light of the acreage number that we saw yesterday. While the acreage planted is higher than last year and higher than the March intentions by quite a bit, 1.4 million acres, it was slightly less than the market anticipated, 150,000 acres. And so the question is, why did we rally 40 cents on a surprise of 150,000 acres? I think the answer is the average trade guess probably really did not reflect the market sentiment. I think the market was, if you will, a little fearful that that number could come in closer to 85 million acres. And when it didn't, we did see a nice reaction to that. Again, on a state-by-state basis, we see a very mixed pattern. Southeast basically reducing soybean acreage. The Corn Belt, except for Iowa, mostly up on acreage this year compared to last year. Again, what might we expect going forward? There's been a very mixed history of actual planted acres compared to the June estimate. The big change historically was last year, and that was basically prevent plant acres because of the extreme wetness in June. So we will expect the final number to deviate slightly from the June forecast. Hard to anticipate the direction or magnitude of that at this point. The USDA is forecasting a fairly small difference between planted and harvested acres. At this point, seeing a relatively small abandonment of soybeans because of weather conditions, only a 650,000 acre difference between planted and harvested. Where does yield come in on soybeans? Trend yield based on a linear trend since 1960, would be 46.1 bushels per acre. As you can see in the balance sheet, USDA last month was using 46.7. We're in that neighborhood at this point, using 46.5, influenced by crop condition ratings to some extent, and also more beneficial rain coming into the drier areas in the immediate future here. So 46.5 based on the planted acreage and harvested acreage forecast, a crop about 60 million bushels larger than USDA forecast in last month, and about a 30 million bushel larger supply, reflecting anticipation of smaller beginning stocks and slightly fewer imports given our big crop. We go with the USDA's forecast of consumption here at 3940. It gives us ending stocks of 290 million bushels, a stocks-to-use ratio of 7.4, and an average farm price about $1 higher than USDA forecast last month. That seems inconsistent given a larger forecast of ending stocks. But again, we base it off of the same kind of stocks-to-use model that we showed for corn. And we took the average of the weak and moderate demand scenarios with a 7.4% stocks-to-use ratio, and that gives us a $10.40 average price. Here, we would say the market currently is well above that price. And unlike corn, where we think that prices now are pretty well supported at this low level, we don't see a lot of downside risk on corn. We would say there's probably reason to be a little patient on marketing new crop corn as we see July weather unfold. We would have the opposite opinion on soybeans, I think, saying given the recent strength in prices, given the high prices relative to corn, given the high price relative to our forecast, given the high price relative to the insurance guarantee, we think now is presenting good marketing opportunities for both old and new crop soybeans. So we rushed soybeans a little bit because I got bogged down in corn. But at this juncture, we're going to turn to the questions that you've presented to us and try to address some of those. If you have additional questions, we would encourage you to continue to feed those to us over the next several minutes. So maybe I'll turn it back to Scott and let him pick a question and start that process.
All right, we'll start at the top. The question is, you've said that speculative money follow trends. What trend do you expect they will be following for corn and soybeans over the next 60 to 90 days? Well, you have to think that there's a bearish sentiment. Prices have been certainly, for corn at least, tracking down, and I think that they'll continue to expect that in corn. Soybeans, a little harder to tell, but I would guess that they would probably be on the bull side on soybeans. It's my guess. Question is, do you have any thoughts on what may have promoted the dropped use in feed and residual use for corn? An excellent question. The difficulty with the grain stocks report is that we all want to take those numbers and say, okay, there was this 194 million bushel surprise, and that means that feed and residual use was much weaker than was expected going into the report. And I think directionally we can't really argue with that, but we have to be careful about over-interpreting those stocks numbers and stocks surprises because of the measurement error that is inherent in those grain stocks reports from the USDA. Darrel and I and our colleague down at SIU, Dwight Sanders, did a major report looking at these issues, and there's just inherently a lot of sampling variability in those numbers. But Having said all that, I still think that number is a bit of a head scratcher given livestock numbers and at least decent profit incentives. I don't know if you have anything to add on that or not, Darrel.
No, I think the point here is that it is feed and residual, and we know that there is a lot of noise in the residual number relative to what you would expect feed use to be, looking at livestock numbers, feeding profitability and that type of thing. And I think, as you said, that all reflects kind of the sampling errors in those reports. So we put a lot of faith in the quarterly numbers, probably more than we should at times.
And I think that's the message. And that's the reason the USDA doesn't take those surprises that they see from quarter to quarter and fully adjust up or down feed and residual use, which does make sense. The question is just how much should you fade them? Another question on feed and residual asks, have you done a regression on the subsequent crop year on WASDE feed and residual when stocks surprise? No, we have not. I'm not exactly sure what's intended by that question. Perhaps, maybe that there's some kind of over or under adjustment. I'm not sure, but we have not done that, so I don't have any information.
So, I mean, the question I think relates to, in the upcoming July report, how does the surprise we just saw in the June stocks affect the projection for next year's feed and residual use?
Okay, right.
And we have not done that formally, but observation would suggest that they tend to move the new crop in the same direction that they adjust the old.
I misunderstood the question.
But probably not one for one, as we've assumed here.
Right.
Because the USDA does recognize that with big crops and low prices, residual use tends to be large. And when you have small crops, high prices, residual use is probably small. So with the expectation of a very large crop in 2016, they're likely to keep feed and residual use projections pretty high for next year.
Next question, Darrel, is if your ending stocks number is more accurate than that of USDA, in what time frame is that information likely to be reflected in market prices? I'm not sure that we would say our ending stocks number is more accurate than USDA. What we're trying to do is to anticipate what the USDA will say on July 10th. And we would guess that that's exactly the mindset and thinking process that the market was going through in the seconds after the release of these reports. And directionally, I think the market was going in the same direction. So I wouldn't say we're more accurate. It's everybody just anticipating where the USDA is going to come out on July 10th.
Right. The other thing to point out is, referring back to our chart on stocks to use ratio and price, to the extent that that's an accurate depiction of what really happens, you see it's a pretty flat curve, so that over a large range of stocks to use, so that a slight change in ending stocks and the stocks to use ratio really would not change price expectations very much.
Right. Next question said, is a comment, maybe a question, said cash wheat price is below corn in western Kansas, but we hear little interest in this point from feedlot managers using wheat and no interest from ethanol. So we need to move wheat because there is no storage for fall crops, expecting a record wheat crop that at the margin will add to the feed supply. Not surprising. And while we don't focus a lot on wheat, Darrel and I personally, we did write about in big El Nino years like this, we tend to get very good winter wheat production, and we did indeed. So that is an interesting piece of information that I haven't seen a lot of interest in wheat feeding, but one would expect it would be elevated this summer with the very large surprise. If I can add a just one comment on that situation, there is one particular aspect of the winter wheat situation that I think is going to be getting more attention. That the stocks may be large enough to cause some convergence problems for the 2 CME wheat contracts. And so that'll be something that will need to be watched carefully as we move forward.
Yeah, just a follow-up comment on the wheat. That's one reason if you take the third quarter feed and residual use of corn at face value and recognize that we could, I had been assuming that we'll feed about 75 million bushels more wheat this summer than we fed last year. That's what makes that fourth quarter corn and feed residual use pretty precarious. I think that so 5150 that we're looking at, even that might be a little optimistic at this point.
It's certainly possible.
Yeah.
And looking at that relationship that we showed for the change from June to July versus the final total change from June to the final would lead room for both further declines and further increases in that number. Let me jump to a question that said La Nina effects this year and potentially for next year. Okay. The question is, we have been in a very large El Nino, as Darrel and I have written about extensively last winter and this spring. And we have just recently transitioned out of El Nino status, although that's yet to be fully reflected in the monthly statistics for El Nino, La Nina. So the question is, how fast would we get to a La Nina? Highly likely that we will go to a La Nina, although you don't have to. At this point, it looks like it would have a marginal, if any, impact here on weather for the rest of this summer. History says as you transition to a La Nina, if that does happen by August or September, that you could have – that has been historically associated with very warm Augusts and sometimes warm and dry Julys, but now we're getting close enough that we can just focus on the short-term weather forecasts, and at least through mid-July right now, they don't look too damaging. So for this year here in the U.S., I don't think it looks like it's going to have a big impact from what we can see right now. But we will have to keep an eye on that for potential impacts in South America next year. Anything you want to add on that, Darrel?
No, I think that summarizes it very well.
Next question, thoughts on June weather impact on corn yields? Clearly, not all of the corn belt in the U.S. has had a great June. There is a significant part of the corn belt that's been warmer and drier than normal in June, and that should, based on the research that we've looked at and our own, will have a negative effect on the potential final yield for corn. How big, the different estimates out there, but it could be anywhere from a ding of 3 to 5 bushels on U.S. average yield versus the potential. But when we say that, we have to be really careful that the big month is just beginning for determining corn yields, and that's July typically. And if we have a normal July with normal temperatures and normal precipitation, that will easily swamp the negative impacts that we accumulated during June.
So we have a question, what are generally considered break-even prices for corn and soybeans? Again, the answer is that it depends a bit on what you include on the cost side for corn and soybean production. But for Illinois, on average, I think we would think in terms of corn somewhere in the low $4 range as probably break-even, and soybeans somewhere between 10 and 10.50 as probably break even to cover all economic costs of production.
Question just came in saying that the new crop 2017 soybean corn price ratio is near 2.53. Any thoughts on changes in 2017 corn and soybean acreage if the ratio remains this or higher? Well, the basic situation is that the market is clearly sending the signal that we need more soybeans relative to corn. And so how are we going to achieve that? We're going to have to provide more incentives for soybean production relative to corn for both South America next year and potentially for the U.S. next year. And so we're going to have to see some expanded production of soybeans or some contraction in corn production or a combination of the two in order to bring these relationships back into closer to their history. Darrel and I were talking about that before we started this morning, and I think you had some interesting statistics on soybean meal relationships and others that really helps bring this into focus.
Yeah, we're just saying if you look at nearby, I mean, we're looking at ratios of 3-to-1, soybeans to corn, soybean meal to corn, when soybean long-term would be 2.5-to-1 and soybean meal to corn about 2-to-1. So those prices are certainly out of whack relative to long-term trends. But for the 17 crop, as you indicate, the ratio of corn to soybeans about 2.5 is more normal, would really not be giving a strong signal one direction or the other for corn versus soybean acres. And that may continue to be the case because, as Scott said, South America will have the first crack here at what to do in terms of reacting to current prices. We would expect to see some rebound in soybean production in South America just from a more normal yield than what turned out this year. So production could increase there without much change in acreage. They also have an opportunity to expand acreage. So what the U.S. needs to do will be partially a function of what South America does this fall or their spring and how that impacts prices and the balance sheets and how the U.S. producers should respond to that.
Okay, next question. It says, with Monsanto and Pioneer both reporting that growers are paying less for their seed, crop protection companies reporting price pressures from generics and reports of more weed resistance to herbicides, at what point do you start to discount using trend yields? Another interesting question. The research in agricultural economics shows that there is a small impact on expected yield from price and profitability. Economics predicts that that would have to be the case. The argument is how big is it? I'm in the camp that it's not very big. You'd have to say at the margin it might be a half a bushel or a bushel, but at most, I think it's very hard to extract out of the data anything bigger than that. I don't know. What do you think, Darrel?
Yeah, I think that's probably right. Yeah.
You know, the economics is clear directionally that there has to be some impact, but I think it's so small it's hard to measure.
We have a question about corn prices, kind of a two-part question or a question asked in two different ways. Do you think corn can go below $3.50? Or asked differently, what's going to cause corn prices to go up from here except weather? Did we price Brazil's corn yield loss, do you think? Yeah, I think clearly we have priced Brazil's corn yield loss, and it's in the form of better exports for U.S. corn. That's in the balance sheet. That's in the market. In the short run, really, weather is the only thing that can push corn prices higher, I think. In the longer term, we keep coming back to the demand side as important, and demand not in the sense of how much corn we use, but in terms of what price end users are willing to pay for corn And that's more a function of economic health, economic growth, income expansion. We really need to get back into a more robust economic situation, U.S. and worldwide, to say that we're moving up the demand scale on corn or soybeans. Again, going back to our stocks-to-use ratio and price chart, what moves us up from a weak to moderate to strong demand, I think, is going to be dependent on world economic growth, and that's still not very robust at this point. So until that happens, we're going to still be thinking in terms of corn prices where they are right now.
I'll jump to another stocks question. Said, how do you know that the Reuters poll on soybeans ending stocks was not a true reflection of market expectations? Well, we're basically inferring that.
Yeah, we really made that comment relative to acreage rather than ending stocks when we said 150,000 acre surprise on the acres, but a 40-cent price reaction.
Right.
I guess we're just taking that at saying 40 cents is an overreaction if the difference was really only 150,000 acres.
Thanks on that.
Yeah.
Next question. Why is the soybean market inverted? Is that a new normal, or what could possibly change that in the future? We don't tend to have a lot of carry that goes across the entire marketing year for corn because we have two major production areas in the world, one in the north, one in the southern hemisphere. And so we can have production response to any price incentives in the other hemisphere, depending on what happens to the weather and production prospects in South America for the U.S. So that's the norm. Would I say that the current inversion is the norm? No, I think that that's a reflection of unanticipated strength in soybean product demand, the market getting caught a little short in the U.S. old crop period, and so we get this inversion. That inversion may be at some risk going forward if we end up having more favorable weather in July and August than we might have built into the market based on El Nino type expectations. I don't know. What do you think, Darrel?
Yeah, I think also you have to recognize that the inversion probably reflects to some extent the unexpected shortfall in South American production this year and anticipation that production will be at a higher level next year. Right. So when you look at deferred futures within the 2016-17 marketing year, those spring-summer prices, I think, reflect expectations of a bigger South American crop next year. So you got some pressure there on those prices.
Makes sense. Another question said, recent reports from Argentina indicates a 20% increase in corn acreage and a 5% decline in soybean acreage. Any thoughts on how the recent more favorable soy-corn ratio might impact that? Again, assuming away any currency impacts that have been flowing through the world markets in recent days, because I haven't looked at that for the Argentine currency recently, one would have to think that the Argentine farmers would be seriously thinking about upping soybean acreage relative to corn. As Darrel and I looked at right now, the projections for new crop U.S. dollar-denominated prices, the futures right now for the current crop year are at over 3-1. So one would have to think, don't you think, Darrel, that they would be seriously considering more beans?
Yeah, you would think so. And I mean, a 20% increase in corn acres just doesn't seem possible to me. It doesn't seem to be a reasonable number. I mean, when have we ever seen a 20% change in acreage in any country from one year to the next? That just doesn't happen. So I don't know where those reports are coming from, but that kind of change is I just think off the charts. Wouldn't happen. Argentine corn acreage is pretty stable. It doesn't change that much, but certainly the current incentives are the other way, as you say, favoring soybeans over corn. And and as you indicated, that's really what we need to see happen on a world basis. Yeah.
We had one question come in earlier, and I want to make sure we get to it. Said, with high corn usage, why do they still consider 2 to 2.1 billion bushel of carry over so burdensome? And I think the answer to that is, it is interesting. Even if we get a 2.2, 2.3 billion bushel carryover, you're still under 15%. So if you look at the wide sweep of history going back 30 years or more in the corn market, that is still not anywhere near the kind of burdensome stocks-to-use ratios we've seen in the distant past. I think the key there is, again, to focus on the stocks-to-use pricing model chart that Darrel showed. Is we're in a low demand state. Maybe we get a little bit of a bump out of South America, more towards the next demand level. But the key is got to keep your eye on world economic growth. U.S. economic growth has been really very tepid, and now pushing 6-7 years. And what we really need to see is world economic growth, particularly for those countries that could be big buyers of U.S. corn and soybeans, particularly for corn, to come back into the market in a major way and have the income that they're willing to buy at higher prices, the quantities that we're generating today. And so I think that's a key point. Anything you want to add on that, Darrel?
No, I think that's fine. A couple more questions. One that came in early was the impact of the strong dollar on corn and soybean exports. This is one that comes up all the time. Certainly, two things happen with a strong dollar. It makes exports from other competitors a little more attractive, particularly South America. And it also, the major impact in my mind is not so much on the quantity effect of the higher dollar, but on the price that buyers are willing to pay for the corn. The higher dollar means, we're exporting a lot more corn now than we thought we would this year, but not at higher prices. The stronger dollar keeps a lid on the price, even if quantity exported is fairly large.
Mm-hmm. Some more comments came on Argentina. A flurry here at the end, Darrel. Said that Argentina has eliminated restrictions to corn exportation, and that is the reason for the bigger acreage area. There's going to be no export tax on corn and a 25% export tax on beans for the 2017 crops. So I guess people are arguing that that's the reason for that big of a change. It'll be something certainly interesting to watch as we go forward.
But the point is, even a 25% tax on beans is not an increase, and with a higher price of beans, it's still a higher net price for the Argentine producer. And even though they're eliminating export restrictions, you got to have a market for that corn. So if you're going to produce more, they better hope somebody's willing to buy it.
That's right. Yeah. So, any more questions, Darrel?
I think we're pretty much done here.
All right. Well, thank you for joining us. We really appreciate everyone who registered and tuned in, and for all of your excellent questions. Darrel and I both enjoy doing these, and we thank you for your interaction. Please remember to visit the downloads page at FarmDoc for webinars. And tomorrow you can get the complete video of the presentation and our Q&A session. And so thank you again, and hope everyone has a wonderful 4th of July weekend.